Welcome to Module 5, Section 7, where I will discuss a strategy known as the SMAC investment strategy.
As we start off learning about this strategy, which is supposed to be a very simple strategy, there are some definitions that we need to be aware of in order to have this strategy make sense and to be able to implement it the right way. First of all, we need to have access to a chart. This is usually available on the internet and is not all that difficult to find. If you need some direction on which way to go, please contact me and I can let you know about that. You'll need to have a daily chart of an index if that's what you are investing in. This can be a line chart. Now, if you invest in a thing called mutual funds, that's the only kind of chart you're going to have because they just calculate one price each day. If you invest in something that trades during the day and actually changes value, then you might find a different chart to be more effective for you. This could be a bar chart, and I'll go through and give some examples of these different kinds of charts. A bar chart will typically have the open, the high for that particular time period, the low for that time period, and then the close for that time period. You may also like to use a thing called candlestick charts. These draw a little bit different and look a little bit different, but they can give you some insight and understanding that you may not get by just looking at a line chart or a bar chart. Most investors have their preference, and if you've worked with charts before, go with whatever you use. Now, we also need to understand what is a moving average. I'm only going to use in this strategy what's called a simple moving average. There's another kind of average called an exponential moving average. I have another video that talks about the differences between them, but I'm not really going to focus on that right here. We use what's called a 50-period moving average. Just for illustrative purposes, I'm just going to assume that everybody is using a daily chart. What you do with a 50-period moving average is just take the last 50 days, add them all up, and then divide by 50. And that gives you an average price over the last 50 days. The next day, the 51st day is added. Well, the very first day is taken off of the calculation. And so what you have over a period of time is a line is drawn on a chart, and this can be useful when we are trying to make decisions. You'll also need to have access to a 200 period or day moving average. A lot of investors use the 200 period moving average as well as the 50 period moving average. There's really no magic. Personally, I found the 50 and the 200 work just fine. So what is the idealized approach that we want to take here? We want to have a strategy that has no emotion. We just want to be able to look at a chart, and when certain things happen, we act. It's purely mechanical. You don't have any decisions to make other than following through with what the computer is telling you to do. If there's a signal that's generated, these are the corresponding actions. If there's not a signal, you do nothing. This strategy allows you to take advantage of both long and short positions. You are in long positions if your hope is that over an extended period of time, the market will go up. And that's what most investors do. However, there are periods of time when the market goes down. And then we have the ability to take on short positions. This is not short selling. Now, some people have a little bit of trouble with this. You might think that it's unpatriotic to profit when the market goes down because you believe in the long-term view of America or whatever investment you are in at that time. Some investors, they don't have any trouble with that at all. They see this as a fact of life and they just say, okay, there's up times and that's what happens most of the time. Then there are extended periods of down times which can be really severe. I will leave it to you to decide if you want to be long at times in the market or if there are times when you want to be short. What are the advantages of this strategy? Compared to other strategies, this is considered simple. I realize if this is new to you and you don't really know what's going on, nothing is simple. Compared to a lot of the other strategies that I teach, this strategy is considered to be simple. When we're using this basic strategy, we're looking at just investing in an index rather than individual stocks. You can also use a thing called exchange traded funds or ETFs, and those have become very popular over the last 20 years or so, and a lot of people prefer them over mutual funds. Either one will work just fine for this. The tools that you need to do this, you can find for free online. The basic idea behind this strategy is it will keep you on the right side of the trend most of the time. This is a trend-based system. This strategy is also very adaptable to your personality, and that's what I would really recommend everybody does that's listening to this. Develop this and use this and implement this based on your personality, on your goals, on where you are at in your life at this time. There's also flexibility involved with this strategy. Market movements can be captured in a simpler way than by just going long or short with individual stocks. That's one of the benefits of using either mutual funds based on an index or ETFs that are based on an index, because we don't have to actually go short. We're not setting up short positions. That can be complicated. The financial requirements are a lot more. You have to babysit those positions. And so for a lot of investors, this is too much work. This is too complicated. Using this method, this is more flexible and you can take advantage of upwards and downwards movement without getting all complicated. An investor can get out, which means you're usually in a money market at that point. So when this happens during a bear market, when we're going down, that's what we call a downward market. And then you can get in during bull markets. This allows you to get out when things get really bad, sit in cash, and then wait for another signal to be generated and then get back in. This can be used with mutual funds and or ETFs. You can have a combination of the two. You might have this through a 401k or some kind of retirement plan, and you may have to do this through the person that's managing that plan. If you have your own portfolio that you manage, you may have to do this through the mutual fund company. Now, some mutual fund companies, they also offer ETFs. An ETF will trade like a stock. And so that might mean that you have to set up some kind of a brokerage account so that you can manage that ETF. You can implement this if you want to be really aggressive. You can go crazy with this strategy and live on the edge, and you like the excitement and you like the possibility of getting higher returns with your investments. Or maybe you're very conservative and you don't want to take a lot of risk. You might be getting either near or at retirement age. You've spent all the time behind you taking those risks. Now you just want to take it easier. You don't want to really go crazy and risk what you've already built. An investor may go many years before needing to make a decision. When we get in and look at the chart of this, you'll see that there are long periods of time when you don't do anything. You make a decision once, and then you might ride that trend for a number of years. Some people might really like that because you don't have to babysit this strategy all that much. Other people say, well, I want something that's a little more hands-on. I want to be more involved. Only you can decide that. What are some of the disadvantages of this strategy? This strategy is not perfect. You are going to have losses. If over a long period of time you follow this strategy, you will have losses at times. Now, the idea is that we cut our losses short and we let our profits ride. Even though there may be losses, these losses won't be really significant. Or if we get into really choppy environments where the market's not really doing much of anything, you might get a lot of false signals, and this could be very frustrating to you, and you might experience losses during those times. The opportunity for whipsaws, where you get in going long and all of a sudden the market shifts and goes in the other direction, that might happen. Or fake outs. You might see a signal, and so you get in there and you do what you're supposed to do, only to have things switch and go the other way, and a few days later, you're out again with a loss that you didn't have a few days before that. That is possible with this strategy. During times of choppy market conditions, there will be losses. It can be emotional at times and go against your logic. I will guarantee you, especially after we've had a real significant downturn and you might be in cash, you're sitting, watching things, waiting for that signal to be generated for you to get back in. You're wondering, oh my gosh, is this going to be a whipsaw? Is this going to be a fake out? All of these emotions are going on in you at this time. You need to decide, are you going to follow the signals or are you going to listen to what your emotions are telling you? It's rarely going to feel feel like the right thing to do when you do it. After we've had a real period of market declines, everybody hates the stock market, and we're seeing prices just go through the floor really fast. And all of a sudden you look at this and see a buy signal. That's not going to feel very good at that time. Those are usually the most successful investments. Not always, but a lot of times when you get into it with some apprehension and it doesn't feel like the right thing to do, those end up being the most successful investments because you're using a pure mechanical system instead of your own emotions to try to tell you what to do. The market has a real way of doing the opposite of what your emotions tell you. You'd be better off a lot of times doing the opposite. You think it's the right time to buy, you should be selling. If you think it's the right time to sell, you should be buying. It's really interesting how that plays out. A lot of other areas in life don't always work that way. The stock market does work that way. This system can take time to generate a signal. Let's say we have a real market decline. Things are going down, down, down. And you think that a bottom has been put in. First of all, one who tries to pick bottoms ends up with stinky fingers. That's one of the cliches that they have on Wall Street. You've seen over a period of time, we've developed some kind of a base or a V bounce out of a drop. You think it's time to get in, but yet the charts haven't confirmed that yet. You're going to get a little frustrated with this, because you're waiting and you're seeing prices go up and you think you should have been in by now, but you're waiting for the signals to cross and they haven't done that yet. There's a real lag with this system. Moving averages tend to move pretty slow and they can take some time to develop. That's one of the advantages of moving averages when you're right, because you can ride the trend. But it's a disadvantage when you're waiting to get in and you see something happening, but you don't see confirmation with the signals. It can take some time for this to generate a signal. So you're going to not get in at the exact bottom or get out at the exact top. The idea behind this strategy is you get most of the juicy part of this move using this strategy. It also may require you to move to a different mutual fund company. That may not be possible for you. If you want to take advantage of the short positions when we go down, not all mutual fund companies out there have what are called inverse mutual funds. There are a lot of them out there, and some companies may use another company's inverse mutual funds. You need to find out, do you have access to inverse mutual funds? If you don't, then you might keep things the way they are. Long-term positions can lead to complacency and forgetfulness. They say that one of the best ways to invest is just sock away a certain amount of money every month and don't worry about it. Let things play out however they're going to play out. And for most of history, that's been a good approach. But times are changing. Who would have thought a year ago that the U.S. economy would have been shut down? Who would have thought that we would have seen the things that we've seen over the last year? I certainly didn't see it coming. The markets didn't see it coming. Most people didn't see it coming, but it happened anyway. What's going to happen in the future? There's a lot of changes taking place. There's fiscal and monetary policy that's being changed. There's a lot of different focus that's going on in the government right now. And there's different focuses on Wall Street right now. Are things going to change in the future, or are we going to have some really bad times? You can make a case for either side. There are the people that are always positive about the market and that we have bright days in the future. And there are other people that are predicting doom and gloom for the future. We have to make our own decisions and decide. Or we use a system like this where the decisions are then made for us. But you might forget about it. And there may be times when you lose track of this, you forget to look at things at least once a month, if not once a week. Check things, maybe every Saturday morning or Sunday evening. You just log into your account, you find whatever charts you're using, and you just look things over. The two moving averages are far away from each other. You're done at that point. You can then wait until the next week. Or if things are looking like they're getting ready to cross, then you know decision time is coming. A decision must be made whether to use this as a completely mechanical system or if you're going to try to get in there and tweak things. That's on you. If you want to use this with some other things, that's okay. But realize that you might tweak them to get better returns only to experience losses that you would not have experienced otherwise. So be careful if you get in and monkey around with this too much. If you have some experience with this, if you have different types of things that you use to make decisions and you're confident in those, go for it. Live large. The idea is to experience the best returns possible. Quickly, I'll mention the difference between mutual funds and ETFs. Mutual funds have provided an excellent low-cost method for individuals to invest. There are other videos that I'm posting on YouTube that talk about mutual funds. I go through this in the class that I teach. I talk about the history of mutual funds. John Bogle, who came up with the first idea of an index mutual fund. Mutual funds themselves have been around for a long time, but they typically have provided excellent low-cost method for people to participate in a broad spectrum of the market. Over the last 20 years, there's been an explosive growth in the popularity of ETFs, and I have different videos that talk about that. I have a whole section where I really go into a lot more depth of ETFs. So for many, ETFs are preferred over mutual funds. They are a good alternative. One of the benefits and drawbacks to a mutual fund is that you only have one price you're dealing with. Now, how is that a benefit? You miss all the noise. The market may experience a flash crash or really go down only to come back at the very end and either recoup a lot of the losses for that day or get back to break even, if not make a gain. You as a mutual fund investor, you're not really concerned with that. The NAV that is published by the mutual fund, the net asset value, it comes out shortly after the market closes and it's based on closing prices. Now, if you're in ETFs, you probably want to keep a little closer eye on things because they trade like a stock. And there's an open, a high, a low, and a close. And if we really get moving in one direction or the other, and that's going against you, you might be more inclined to jump in and do something without a signal even being generated. So there are other posted videos that go deeper into the explanations and different alternatives that you have available, as well as the advantages and disadvantages of mutual funds and ETFs. Let's get into an example of what we're going to do here. We're going to look at two different vehicles, a mutual fund and an ETF. The mutual fund that we're going to look at is the Vanguard 500 Index Fund Admiral Shares. This was the very first index fund developed by John Bogle, and the symbol is VFIAX. So you could put that into Google and you will get some kind of a result back and possibly even a chart that you can look at. This is a mutual fund based on the S&P 500. I personally like the S&P 500 most. This type of a strategy, if you use the Vanguard 500 to do this, you're only going to be able to go long. But for some of you, that might be just fine. Then another thing we're going to look at is an ETF, and this is the most popular ETF out there. And there are a multitude of strategies that I teach in my class that you can implement that are just based on the SPY. It is an ETF. It's based on the S&P 500, so you don't have stock selection that you have to go through in order to implement this strategy. It's already been selected for you. So all the time that you spend uncovering stocks, you don't need to do that. Now, you may enjoy doing that, and that's wonderful. That's great. If you really get a charge out of finding all of these different investments and doing the research and analyzing one company against another, go for it. That's your personality. That's what you like to do, and you can be successful doing that. There are other people that don't really like this. They know the stock market is important. They have an investment program, but they don't really want to dive deep into this. And so this is fine for them. There's diversification. There's certain criteria built into the S&P 500 so that if a dog company is in the index, it'll get taken out and new companies will be included. When you're using the SPY, there are opportunities to go long or short. Simple moving averages are used rather than exponential moving averages. And I have another video that talks about moving averages, but there are different kinds of moving averages out there. So you have this debate about what kind of moving average is the best. You can use a simple moving average if you like that. If you're keen on exponential moving averages and that's what you like, use those. Then the differences, strengths, and weaknesses of SMAs and EMAs are covered in other videos, so please look for those. Here is the system, and I just call it SMAC. It's an acronym for a simple moving average crossover. We use a 50-period moving average and a 200-day moving average, and when they cross over, that's when we do something. As long as they don't cross over, we don't do anything. Here are the rules for this particular strategy. You get in long. That position is initiated when the 50 simple moving average crosses above the 200-day simple moving average. As I'm thinking about this, I tested the system out a number of years ago using weekly charts, and it sucks. When you combine the moving averages with longer term charts, it's just too slow. And you're getting in way too late, and you're getting out way too late. That's just what I found. Now, if you've done some experimenting and research based on this, share that with me. I'd love to hear about that. A daily chart, to me, seems to be what works best. If you have any short positions prior to the signal being generated, you will close those out, and then you will go from being short in the market, and you will then initiate new long positions. And you will just ride those for however long it is until another signal is generated. A short position is initiated when the 50-period moving average crosses below the 200 simple moving average. Any long positions you have at that time are closed. If you only do long positions, you're going to cash at that point, or you may switch over into an inverse mutual fund or an inverse ETF. Usually, this is a long-term strategy. It's designed to be that. Because of whipsaws, because of fake outs, sometimes we have a lot of false signals that are generated. We don't know that they're false at the time. They end up being false a number of days later. But the idea is that you ride this for the long term. There are different optional parameters that you can set in order to get in or to initiate a new position. It's usually best to initiate a new position as close to the market close as possible. This is my own rule. This may not be possible if you're using mutual funds. You don't have a choice. This applies to ETFs. Now, why would I say such a thing? If you can get in and you're looking at something that costs 10 and all of a sudden you can get it for 9, isn't that a good thing? I don't think so. A lot of people teach and implement a strategy where they think, now I'm getting something on sale. Well, hold on a minute. You remember the whipsaws and fakes that can sometimes happen? What if we're getting a signal, let's say on a Thursday, and we plan on implementing that on Friday, and that signal tells us to go long, and we just have a really, really difficult down day? Are you going to want to get in at that point? Maybe the situation has changed. I usually like to implement these types of strategies using ETFs as close to the market close as possible. Just because if we have a day that goes the opposite of what the charts are telling us, we might want to wait one day and see if things change or if they stay the same. Now, some of you may not agree with that. Once you generate a signal, you're just going to go completely mechanical. You're not going to look at the market. You don't care what happened that day. That's based on what you think is the best thing to do. And this may not be possible for some investors. You work jobs. Now, one of the nice things about living on the West Coast is the market closes at 1 p.m. When I usually execute a lot of these type of positions, it's usually during the last hour, as close to the close as possible. And mutual funds will have a cutoff time. ETFs, of course, you can trade right up until we get really close to the close. The nice thing about being on the West Coast is that's 12 to 1 o'clock Pacific time. And that's the lunch hour. So if you want to implement something like this and you have that as your lunchtime, you can take advantage of this strategy. Now, others that live on the East Coast or in other parts of the world, that may not work for you. Or you may not get close to a computer all day. You might be driving around or out in the field or doing whatever you do, and you can't watch things. So you have to make your decisions in the evening or on the weekends. A new position is initiated if the market closes in the direction of the strategy. If you're getting in, hoping that something is going to go up, why in the world would you invest in it still if it's going down? That's my personal philosophy. There's a saying in the markets that amateurs open the market, professionals close the market. Now, sometimes that's not always true. We have buy programs and sell programs that kick in right during the last few minutes. There's adjustments that are made in different indexes at times, and there are things that can really make the close kind of crazy. For the most part, it's near the end of the day when a lot of the big players, that's when they start to do their shifting. They're getting in or they're getting out. And now we've had a whole day to watch kind of evaluate where we're at. A lot of times when we're implementing this, if you're a member in the program, I'll go live on these days. I'll actually do a live broadcast for the last either 30 minutes or 60 minutes. We can watch things as they unfold. Some of us have cutoff times. We can all get together in this room and watch what's happening. Sometimes that can help you to make a decision. What we have right now is a chart of the SPY, and it pretty much mimics the S&P 500. There's supposed to be a one-to-one relationship. Sometimes it gets a little out of whack, and as things change, different ETFs, including the SPY, they may have to adjust the number of shares in particular companies. What you see right here is just a bar chart. This goes back 20 years to 2001. This is just a chart of the closing price for that particular day. And you can see over a period of time, there were times when it went up and there were times when it went down. This gives you a visual cue as to what has happened in the past. It doesn't always mean it's what's going to happen in the future, but at least we can make decisions based on what has already happened. If you're looking at a mutual fund, this is all you'll see because they only have one price each day. So another chart that you may look at from time to time is called a bar chart. It's kind of hard to distinguish here, but you can see where there's an open, a high, a low, and a close if you look really close. And it just gives us more information. Now, if we want even a little bit more of a visual insight, we can change the colors. We can go with Christmas where it's green when we go up and red when we go down. It's a little hard to see because I have such a long-term chart here. Sometimes you can get some insight by noticing, there's an awful lot of red right now. There's an awful lot of green right now. And then we get with the TV show and there's a lot of red, green, red, green, red, green going on. That sometimes will help us to make decisions. And then another kind of chart, and this is kind of hard to see on this one. These are called candlesticks. And that's a whole different way of being able to draw a chart. If it's up, it's green. If it's down, it's red, just like the bar chart. There's a whole discipline of candlestick charts and chart patterns and coming up with what they mean. I don't get a lot into that. I've studied it. I've got a lot of books on that, but I haven't found it really useful for what I do. What we do on the next chart is we can plot a 200-day simple moving average. That's the red line that you see right here. Now, we can get a lot of information just by looking at this. If it's going up, is the market going up? Yeah, for the most part. If it's going down, is this line going down too? Yeah. Does this line act as either support or resistance at times? Where prices came all the way down to this moving average and then bounced in the other direction? Yeah. How about resistance? Where they went all the way up to this line and then turned and went the other way. Then we can see where prices are in relation to that line. We can also apply the 50-period moving average. That's the blue line that you see. When the blue line is above the red line, that's positive. When the blue line drops below the red line, that is negative. And that's the strategy right here, folks. That's pretty much all you need to do, is just watch for these lines to cross. As long as they don't cross, you don't do anything. Here is the Vanguard 500 fund that I talked about earlier. And again, it only has closing prices. We see crosses. That's when you initiate a long position, when the blue line goes above the red line. And then when the blue line drops below, we get out. And if you only use mutual funds, you're in a money market at that point. And you're considered to be safe. So wouldn't it be nice if you could use a long-term approach, but still avoid a lot of the real downturns that are just part of life? What if you could use this strategy just to avoid those and that's it? You may not agree. You might see some real shortcomings with what I'm talking about here, and that's okay. If you have good, solid reasons, contact me. Let's talk about it. Another thing that I'll quickly talk about is a thing called money market accounts. Think of this as like a savings account or something that's really, really safe. If only long positions are used, there will be times when you as an investor will be out of the market. When you're not in the market, the funds that were in the market are then placed into a money market account. Money market accounts are available at mutual fund companies as well as at brokerages. It might be a little bit different for you because you're in a 401k or a Roth IRA or something like that, where you may not have access to a money market account. Each situation might be a little bit different. Typically, this is where funds go when you make a deposit. They are considered to be very safe. They're also very liquid. You used to have check writing privileges with money markets. Some of you may not even know what writing a check means. That just means that you can get to this money instantly if you need to. Usually these money market accounts are interest bearing. That's going to be so minuscule, but the money market accounts that I have, they're compounded daily. And that's kind of nice. You get a little extra chunk of change, but you're not going to retire on the interest that you get from these money market accounts. And this is used as a place to park cash. When you don't know what to do nothing and keep your money in a money market fund. Because sometimes cash is king. When we see things really going against the market, especially if you're just a long investor, everybody's freaking out and they're getting ready to jump out of windows, and you hear about this on the news and it's front page in newspapers. Well, usually that means we're just about over. You're just sitting back going, I'm not worried at all. My funds are in cash right now, and I'll wait and redeploy that cash when the time is right. Wouldn't that be nice? With a little bit extra work, you can do that. You can avoid those really, really messy times. What are some of the alternatives? I've talked about the Vanguard 500 and the SPY. There are other things that you can use out there, especially if you're more of a risk taker, or you like a little bit more excitement in your investment program. There are many different investment vehicles which can be used to implement this strategy. You can use this as the basis for making your decisions, but then you don't have to use just an S&P 500 mutual fund or an ETF. Some of the vehicles that you might think of include the SPY itself. There are also different S&P 500 ETFs. The SPY is not the only game in town. Vanguard offers them. Different mutual fund companies will offer not only mutual funds, but ETFs as well. So you may use something different. There are also regular mutual funds, like the Vanguard, but they also have enhanced mutual funds. Isn't that interesting? For those of you that don't mind taking on a bit more risk, this might be something that interests you. An enhanced mutual fund is set up so that if the S&P goes up 1%, this fund may go up 1.5% or 2%. That could be really interesting if you're right and you can see some really cool returns, but what if you're wrong? The S&P goes down 1%, the value of your account just went down 2%. Yikes. So there's two sides to think about if you're looking at getting into these kinds of vehicles. But for some of you, it might be just the ticket you need to make it a little more exciting. There are also enhanced or juiced ETFs. There are ETFs out there that go on a one-to-one basis, like the SPY. Well, there's also an ETF that goes 2 times, just like the mutual fund I described. There's also a 3 times ETF. So if the S&P goes up 1%, that ETF goes up 3%. Really, really cool when you're right. Really, really frustrating when you're wrong. Then we also have inverse S&P 500 mutual funds. There are companies that offer them if that's something that you want to do. The idea is if the S&P 500 goes down 1%, the value of this index fund will go up 1%. Then the inverse of this is also true with ETFs. If the S&P 500 goes down 1%, this ETF will go up 1%, but there's also a 2 times and a 3 times ETF available. What is the conclusion we can come to based on this? The 50-200 simple moving average crossover system, SMAC, strategy, it's relatively simple to implement, which can be used to take advantage of long-term trends. That's the idea behind this, is that yes, there are periods of time when the market goes sideways, but there's also significant periods of time when the market does trend, and we can take advantage of that. There is great flexibility with this strategy that allows for minimum effort. A lot of the tools that you need you can find for free. The idea is that there's an avoidance of losses or a profit capture during major market declines. You can go long with this strategy or just short, or you can go long and short. You can be very conservative with this approach. That's more conservative than just investing in a mutual fund. You can make adjustments to your current accounts if you have to. Please always know that no system is correct 100% of the time. There's no perfect system. There are systems that are developed that work for a period of time. They usually become popular and a lot of people start to implement them. and they end up breaking down. The idea is, in the program that I teach, we plan for the other contingencies. We may not be right, but we're not going to get wiped out if we're wrong, or we may just break even if we are wrong. Investors must understand that there will be minimal losses with this system or pretty much any system. There's going to be times when you are wrong. And don't try to take a percentage, like I'm right 9 out of 10 times. That's actually a misnomer. If you really follow this system, you will have a losing percentage because of the whipsaws and the fake outs. So you might have 7 out of 10 that were losers, but those losses were small, where those 3 winners were really nice and lasted for a long period of time.
This concludes Module 5, Section 7, and I'll pick up again in another crazy section in Section 8.